everyone, welcome to this Womenomics video, which is part of a series of videos about the investment journey. In these videos, we will discuss everything you need to understand how to start your personal investment journey. As there is so much to cover, we are going to do it in bite-sized pieces as we build up our investment and process knowledge. So let's start with the early part of the investment journey, the actual core mechanics. Though before we do begin, a key question we want to make sure we are asking ourselves is, why invest in the first place? What is the whole point of investing? As a bit of a recap, at the moment, the Reserve Bank of Australia has set the cash rate at 4.1%. Previously, interest rates have been much lower than this. For example, when the Reserve Bank of Australia set the cash rate at 0.1% throughout all of 2021, all other core bank accounts and term deposits were very low too. What this meant was that as you were saving cash from your salary, i.e. what was not being spent on bills, holidays and groceries and all other needs or wants, you were probably only earning 0.5% higher than the Reserve Bank of Australia cash rate if you continued to hold your savings as cash. Which brings us to how can we do better? Because over the longer term, we certainly want our wealth or our cash or our investments to be growing over time. If you can recall from the Womenomics video about the Australian economy, where we reviewed economic indicators, we definitely want to be keeping up with and ideally exceeding inflation. So what are our options? Well, let's look at the categories of options we have available to us. There are many different investment categories, and we have put these into 4 general categories. We have direct shares, we have exchange traded funds, we have listed investment companies, and we have managed funds. We are going to explore each of these investment options in various videos. However, this video is just going to focus on direct shares. The reason that is the case is because each of the 4 investment categories is just that little bit different and has a lot of detail, and we would rather focus on direct shares because that is arguably the one form of investing which the majority of people talk about. So what are direct shares? Direct shares go by a whole lot of names. They are called direct shares, of course, shares, stocks, or equities. In effect, what these terms mean is that it represents ownership. If you own shares, you have ownership or part ownership of a company. And this company will either be listed in a public market like BHP or Commonwealth Bank, or it will be unlisted or private, which would be ownership of, say, a medical practice or an accounting firm, a company that you work for or that a friend works for. But the bottom line is that it is something that is unlisted. We are going to come back to unlisted or private investments later. In this video, we are going to focus on publicly listed shares. Using the concept of owning a share, in its simplest form, if you establish a company, you can issue 2 shares, 4 shares, 10 shares, 1 million shares. Generally, people start with 2 shares, of which you become the owner of one of those shares, making you 50% owner. BHP though, for example, or Commonwealth Bank, well, they have millions of shares and you will be a small, or well, you could be a large shareholder, but if you own, say, 100 BHP shares, you would be a very small shareholder. It's important that you are a shareholder, however, because you have rights and other items that we are going to come back to, but all the same, you are a shareholder if you have ownership through holding shares in a company. A really key topic just to touch on is that who owns that share is really important. In that, are you buying the shares directly or is someone else buying them on your behalf? Back in the older days, well, I don't want to say olden days, but back in the older days, how you proved you were a shareholder was that you had a share certificate. This share certificate was the evidence which demonstrated you owned a share in a particular company. Some people, what they might do is ask someone else to buy shares on their behalf. You really want to make sure they are doing it in your name, not under what is called a custody basis, as in effect what this would mean if you have shares held for you on a custodial basis is that you don't actually hold the direct shares. These are held by someone else on your behalf. So it is really important you make sure that if you are buying shares, that it is done so in your name. By owning shares in a publicly listed company, what this means is that share represents your entitlements, so your rights to the profits or the losses, as well as any current value, whether it be growth or loss in the value of that company, in the proportion of the shares you hold. Listed shares are of most interest to investors, which is why we are talking about them in this video. And listed shares are always registered with a stock exchange. The most well-known stock exchange is the Australian Stock Exchange, otherwise known as the ASX. You have probably heard this acronym referred to a lot. The ASX is the primary stock exchange in which most Australian shares are registered. There are many other types of stock exchanges. For example, there is the New York Stock Exchange, or the NYSE as it is referred to in acronym form. There are other stock exchanges in Asia and Europe, and they all have their own acronyms, and there are many of them. The main one we are going to focus on is the Australian Stock Exchange, or otherwise known as the ASX. Now, being part owner in a company means that if the company makes a profit, these profits are distributed, and these distributions normally take place as a dividend about twice a year. You as a shareholder receive this income directly. The reason you might hold shares would be to earn income, but you might also want to own shares with the expectation that those shares will go up in value and you will see some share price growth. The general concept is that you would be buying in at a low price and selling at a high price over the course of your investment journey. But it is really important to understand that shares, as with all investment asset classes, can go down in value, and that's a key risk. There is no such thing as a free lunch. There are always going to be risks. Now, in terms of the shares that you hold, whether or not you are compensated for that risk, either in the form of, say, dividends compared to the current cash rate, by investing in shares, you are going to get a dividend rate that could be perhaps 5% or 6% each year, compared to a cash rate, which is generally, but not always, less than this. And you might feel that the difference between the cash rate of your bank account and 5 or 6% dividend rate might compensate you for the risk you are taking. Of course, the possibility of growth in the share price may also compensate you for that risk. So what this means is that if the share price grows, let's say 8% in 1 year, and you have a 5 or 6% dividend on top of that, you've received in effect 13 or 14% of a total return that year. Compared to cash returns, assuming your cash account or your bank account is paying you 4%, then you have clearly outperformed your cash returns. Cash generally offers low returns, but as I said before, not always. Because in Australia, if you hold less than $250,000 per bank, you are government guaranteed. So if something was to happen to, say, Commonwealth Bank, and you held $20,000 in a bank account with the Commonwealth Bank, and the Commonwealth Bank got into some serious trouble, the Australian government would guarantee you for that $20,000 up to a limit of $250,000. This limit is what we call the government guarantee. So provided you trust the Australian government, there is nothing more, arguably, secure than a government guaranteed bank account. And that's why you don't get compensated for a lot of risk, because your cash won't move or won't change. If you put in $1,000, you can withdraw $1,000 at any given point in time. You will earn a tiny bit of interest along the way, and that's really all you get. So the return is extremely low, and oftentimes it doesn't keep up with inflation. People that want to keep up and surpass inflation take on risk. With shares, you run the risk that it goes down in value, that the company goes bankrupt. You also run the risk that the company does not pay a dividend from time to time. Companies do not have to pay dividends. Dividends are not controlled by the same terms and conditions as, say, a loan, whereby you must pay back that interest on a regular basis. The company has full discretion as to whether or not it pays a dividend. So you are taking on risk, but you are aiming for higher returns. Now, when thinking back to that comment I just made about companies not having to pay dividends, that doesn't necessarily mean they are a bad investment or that they are not a profitable company. It may be that it is just a different type of business. Using, say, BHP and Commonwealth Bank as examples, these businesses are what we would refer to as very mature businesses. I'm not saying that these businesses are predictable, they are just much more established and well known with large market share. BHP and Commonwealth Bank, just like any other company, will go through ups and downs, but arguably, you have much more confidence in their ability to pay dividends. As I said before, it doesn't mean that companies which can't pay dividends or choose not to are poor investments. Because, for example, if you take a look at very high growth companies like Apple, Apple is not known for paying dividends. It is known for reinvesting its profits back into the business rather than paying dividends to shareholders to keep on growing and growing, building more products and developing its market share. So what this translates into is really high, or you would expect a high share price. So if you bought Apple shares at say $10 per share and fast forward 5 years, it had grown to $100 per share, even though it didn't pay a single dividend at all in that time frame, you would have done rather well. The way you could look at shares is that properties are no different. Some properties will pay rental income just like dividends paid by shares. Some properties will grow if they are in a very high growth market, or they may not. Just like a share price might grow if it is in a really good market sector and the business is run really well, or it might not. Each market is going to be different. Some properties are going to be really unique or have some sort of flatline period. Others are going to be really high income producing, say, for example, like commercial property, which is traditionally a very high income paying type of property. And some properties might not grow, or they might even decline. What it comes down to is what is happening around them and the market they are in. It's really important that you remember past performance. So if a share, for example, has done really well, is not an indication of future performance. So with all that said and done, how do we get started with investing in shares? Well, the good news is that anybody, once they are over the age of 18, can buy shares. You can do this through a licensed share broker. There are many types of different share brokers, and you can get them right through from an online broker to a full service broker. They all have different varying fees as well, and that's really important, and we will come back to this. Now, when looking at the different types of share brokers, whilst they are all different, and we will explore this, in effect they execute in the same way, in that you place an order, it's then placed by that broker on the stock exchange. Now, whilst you have previously, back in the older days, you would have received a share certificate confirming that your share purchase had taken place and you now owned a portion of a company, these days it is all done digitally. In effect, what this means is that once the broker has placed the order for you and it is completed, you will receive a contract note, and this contract note will outline all the different items. For example, let's say you wanted to buy 1,000 shares of BHP. That contract note would confirm the price you set, if you set a price, the total dollar value of shares that were ultimately bought, i.e., even though you might have wanted to buy 1,000 shares of BHP worth, I guess, let's say $10,000, the value might have ended up being $9,990 or $10,020. And then there would be the fee applied. Now, this fee is what we call brokerage. So let's just talk a little bit about fees and why they vary. Stockbrokers, if you will, even though I prefer not to use that terminology, it is what it is. These brokers involve, if they range from, say, being online is just what they refer to as execution only. There is no real service provided with an online broker. They are literally accessing, you are literally accessing, in effect, somebody who is just going to place a trade for you. You are not looking for any research or any advice or for anyone to assist you in any real formal shape. You are driving every single decision. The brokerage or fees generally range from, say, $20 to $30 to $40 at the really low end. As the amount you are looking to buy, say, if you're buying $500 worth of shares, well, you can expect the brokerage to be either $20 or $30. If you were to buy $20,000 worth of shares, the brokerage may end up being, say, $100 or $200. So that's really what they call an online broker, and this could include ComSec or NabTrade, for example. There are also what we would call professional investment advisors, so your full service advisors, where they will do research for you and provide you with formal recommendations. They will be very across all the different things happening in your personal circumstances, the whole know your client ethos. When you place a trade through a full service broker or professional investment advisor, they will have higher fees, which will probably be on an estimate basis about 1%, with a minimum brokerage rate of, say, $100. So if you were buying, let's say, even $1,000 worth of shares, be careful with a full service advisor, because that will end up costing you the minimum, the $100 in brokerage. So a full service advisor is often used when you have, say, a couple $100,000 worth to invest, because that would then justify the service and the cost involved. Just because a share broker or stockbroker charges higher fees doesn't necessarily make them the bad guy, or that they are trying to pull the wool over your eyes. You really want to understand what it is the service that you are getting for that cost. Some full service advisors or brokers do what they call an uncapped arrangement, so it is 1% uncapped for whatever dollar value you are investing. Some do a capped version, so it will be capped out at, say, $300. So if you were to invest $50,000, 1% uncapped would be $500 of brokerage, whereas in a capped arrangement, which is arguably more of a fee-for-service arrangement, it will be capped at $300. So if you're buying $50,000 worth of shares, well, it'll cost you $300. Whatever form you take, just make sure you do your research. Equally, before you buy or sell shares, make sure you also do your actual investment research. There are many forms of information about what to invest in. You can look at the ASX website. You can look at your broker's website. Let's say you use CommSec. CommSec provides a lot of different information, whether it is formal research or information telling you about how many buyers and sellers there are of that particular investment you're interested in. Economic reports. Morningstar is another great source of research. So whatever form you choose, just make sure you are doing copious amounts of research. Personally, I really like to find professional research analysts whose sole job is simply just to do research. But not all analysts are quality. Some do a much better job than others, but you will get a good sense after a while as you start to look at different forms of research, as you view different websites, whether you go to CommSec's website or a full service advisor's website, or you look at the ASX website, or you look at Morningstar, or if you go through Google, even, and just do a bit of a look around at all the different forms of research available. You will get a stronger sense as time goes by as to which source you trust and which you prefer to cut out. You can also pay for subscriptions, and of course, most importantly, there are some great podcasts and YouTube videos out there too. Some investment experts will offer paid subscriptions, and these can also be very useful. The other option, of course, is that if you do have a full service advisor, these professional stockbrokers or full service advisors, they have their own research house. So they have lots of resources at their disposal, and that is what you are paying for with a full service advisor. They will also have potentially years of experience behind them as well. So if you really want someone to help you quite intensely, having a full service advisor with specialist expertise in direct shares can be incredibly useful. Now, in terms of some terminology, when you are setting up an investment account, there are two acronyms you will come across. One of them is a holder identification number, or HIN for short. This number begins with an X and has 10 numbers after it. This number is just like your bank account number, i.e. your BSV and your account number. It identifies you as an investor, and it holds the number that holds all of your shares. So HIN, this will get talked about a lot as you start to invest and talk to other people. The other acronym that comes up a lot is your CHESS account. So what that is, again, is like an overarching account you are setting up which has your name, your address. CHESS stands for Clearing House Electronic Subregister System. When you trade, you must set up first and foremost a CHESS account which has a HIN attached to it. So a CHESS account is the account you establish with your broker, whether that is with CommSec or NabTrade. You might even look at Morgan's, Financial, or Macquarie, UBS, Bell Potter, and any other group. They will have a CHESS account for you which has a holder identification number, or HIN, as we've said before. If you decide to change brokers, let's say you have CommSec and you want to move to NabTrade, your CHESS account will need to change. So NabTrade will need to set up a new CHESS account for you, but your HIN, your holder identification number, will remain unique, and you can just transfer it across from CommSec to NabTrade into your new CHESS account. So this is really important terminology. One of the really great aspects of investing in shares is transparency. What I mean by this, for example, is when you place a trade, before you place a trade, what should happen is that the fees should pop up. So what will happen is you go to place a trade, a little window will pop up and it will say, you know, Jane, you're about to place a trade to buy $1,000 worth of BHP shares. That will end up being 20 units, which will total $1,002, but there will also be a fee of $40 which will apply. Now, what is really important to note is that 1, you should have supplied a valid email address so that all this information will be sent to you in due course, and 2, when you are looking at buying and selling shares, have a look at who is buying and who is selling, i.e. what are the volumes that are being placed. You can have a look on the ASX website or the CommSec or NabTrade website, or whoever it is you have signed up with, as to what price is being traded and how many buyers and sellers there are. Also, probably the most important thing, make sure you have a bank account linked to your online trading account. Money must be in the account before you trade. If you do not have money in your bank account, you will be charged extra fees if you have bought shares and there are no funds to settle with. Now, in reality, most advisors or online brokers, to be honest, they will not allow you to trade if you don't have a linked bank account with cash in it. So, What are the benefits and the risks? Although we have touched on quite a few of these already, for me, one of the key benefits of investing in shares is liquidity. To give you an idea of how liquid or available a company is to buy and sell, you can buy or sell shares anywhere from 10 a.m. to 4 p.m. Monday to Friday. There are so many ways you can buy shares. You can set the price, you can do what is called an open market order, whereby you just take any given price available at the point in time at which you buy or sell. You can do an order that remains open until the end of the day, so it will be pulled or cancelled if it hasn't been filled or completed by 4 p.m. So let's say, for example, on a Monday morning at 10 a.m, you decide to place an order to buy BHP shares, but you want to buy them at the specific price of $25. Now, let's say they are currently trading at $30. You think on that particular given day, because of some news you read regarding the price of iron ore falling fast overnight, you think BHP shares could fall to $25 that day. Now, let's say throughout the course of the day between 10 a.m. to 4 p.m, BHP shares only fall to $27. Your order at $25, if you set it to close at the end of the day, at 4 p.m, your order will be cancelled. So you are not running the risk that this order continues to remain open indefinitely. But if you think at some point BHP shares will eventually fall to $25 beyond that day, then you can place what is called an open order. You place the order at a price limit of $25 and it just stays open for quite a long time, almost indefinitely. The only reasons that order will be cancelled, and this is what we call an order being purged, is that if BHP pays a dividend, all orders have to be cleared or cancelled the day of that announcement. Sorry, the day it is ex-dividend. So you will need to go back onto the market the next day once the dividend has been declared and it's gone ex-dividend and reinstate that order. You should get a notification from your broker about that, or if the company does what they call a capital raising. So let's say BHP decides it wants to raise more money, and it can do this by declaring they want to raise, say, $100 million, and they are going to then invite existing shareholders to participate, if they would like, and elect to buy more shares. If they do that, then all orders on market will be cancelled as well, the day that announcement is made. So you just want to be very aware and watch that order if you have placed what is called an open order. You should get notifications every day or at least once a week from your stockbroker or your licensed broker saying that the order is still open if you have orders in the market. So that way you can keep checking to make sure it is still in place. But shares, as I said overall, are very transparent in that way. They are reasonably easy to sell, but the key thing you really want to know is that you make sure that shares and their liquidity, well, effectively that you've really checked that out. What I mean by this is that BHP and Commonwealth Bank, well, they trade in millions and millions of shares on a very regular basis. If you bought some BHP shares and decided you suddenly needed to sell some and you don't need to sell all of them, just a portion, let's say you own 1,000 BHP shares, well, you may only want to sell 100 and you can get onto the market and do that really easily. Which is quite different to say, well, a property. You buy a property and it costs you $500,000. You can't just hive off a bathroom and say, hey, I need $50,000, so I'm going to sell my bathroom. Not only is there not really a market for bathrooms not attached to houses out there, even in the property market, in and of itself, for those of you who have gone through the process of either buying or selling a property, it's not transparent and it's not really liquid, and you can't go and simply check the share price that day, i.e. what the price of a property is at any given point in time, but you can with listed shares. On the ASX website, you can go and have a look at any given point in time as to what the share price is. The other thing to note with shares is that they have what is called a T+2 settlement period. What this means is that if you want to sell shares in 2 days' time and you place the sell order, you receive the sell proceeds. If you buy shares in 2 days' time, you'll need to pay for them. So this is a very quick turnaround time in terms of transacting in shares. Again, unlike a property, there could be a 30-day or a 60-day or a 90-day settlement period or longer. And this is assuming you have a signed contract and agreement to transact. You might spend months looking at getting people in through the property, doing an inspection, and on it goes. So shares are a great way to invest in terms of them being very liquid and transparent. That being said, as far as things go, some people don't really care about liquidity. Some people really want to be able to buy and sell at any given point in time, but other people just want to buy shares and hold them for decades and decades. And that's fine. It's just important to be aware of how liquid a share can be. Some people who do hold shares for years and years will even accumulate shares over time. What that means is that if a company pays dividends, you can either elect to receive the dividends as cash, or you can reinvest the dividends. And this is what we call a dividend reinvestment plan. The other way to accumulate shares over time is, if you don't necessarily want to go back into the market and buy them, is to make use of the capital raisings which companies do from time to time, otherwise called either a share purchase plan or a rights issue. Share purchase plans are usually capped at $15,000 per offering, and rights issues are usually done on a ratio basis, i.e. buy one share for every 5 you already hold. Usually larger companies will offer a dividend reinvestment plan, and often this reinvestment process is done so at a small discount to the current share price. Let's say the price of BHP is currently $30 and you have elected to reinvest your dividends. The company, BHP, will often offer you a 2.5% discount or something in that vicinity on the current share price for reinvestment. So let's assume it's a 2.5% discount. Well, your dividends would be reinvested at the price of $29.25 rather than the current share price of $30. So often a dividend reinvestment plan is a really attractive way to invest over time. Additionally, because it is automatic, you are buying shares generally every 6 months through the dividend reinvestment plan through all sorts of different market conditions. Sometimes you might be getting shares through the dividend reinvestment plan at $40. Sometimes it might be $20. This is what we call a dollar cost averaging approach. You don't have to think or worry about the price at which you are buying them at, it just happens automatically. Over time, it means you have averaged in and bought at all sorts of different prices, so you are never really thinking about trying to pick the best possible price. You are in the market and you are just gradually accruing more shares over time. Hopefully, ideally, the share price is gradually appreciating. What is important to remember, if you do put in place a dividend reinvestment plan, you still have to declare those dividends on your tax return. It doesn't matter that the profits have just gone back into the business or you have reinvested the shares. It still comes as income on your tax return. One other thing I'm just going to put out there as a benefit before we start looking at the risks is that not only do you have transparency in terms of seeing how many buyers and sellers there are, in terms of seeing the share price, you also have access to all the announcements. Because when a company agrees to list on the Australian Stock Exchange, that company is committing to making available to shareholders or to future investors even, public announcements and public information. So you can have a look at their annual reports, their announcements, their interim reports, their updates. It gives you really good access to information on what their business activities are, on what their cash flow is like, if you really want to go into all that detail. Also, you can go and visit the company website and read on what their descriptions are and start to read news articles about them. Sometimes they will even make available on their websites external research produced by professional investment analysts. To be fair, they'll generally only put up the positive reports, but it is still good to go and have a look and see if they have made any research available. Let's now turn to the risks before we turn to the final part of this video. One of the ultimate risks of investing in shares is company bankruptcy or complete capital loss. Now that is the ultimate risk, whereby the company you have invested in goes broke. There is no recourse. You will lose all the money you had invested in that company if it goes bankrupt. So that whole notion of being too big to fail is a complete and utter illusion. And let me tell you, there are no shortages of stories of companies going broke. So be really, really aware this is a possibility. But this is why you are equally running a positive risk of being compensated by dividends and share price growth, but with the ultimate negative risk, of course, that you run with the company going potentially bankrupt. And even if a company doesn't go bankrupt, if the share price falls below the price you originally paid for it, you will receive or have incurred an unrealized capital loss or paper loss. You haven't sold, but you are technically in a loss position if you do decide to sell. So just be really well aware of that. The other risk is that dividends may not be paid, that the business owners or senior management might change, sometimes for the better, sometimes unfortunately for the worse. That the market sector that the company is in changes, and these changes can happen fast. If you think about technology today, look at Kodak. Kodak as a company used to be, believe it or not, a market darling on the stock exchange. It used to be really popular for investors to hold. But where is it today? Well, when you look at what Kodak used to do, which was manual film-based photography, these days, you can get a digital camera on your smartphone. So companies like Apple, for example, have completely disrupted Kodak's market, and so Kodak has become more irrelevant. Being really aware of what is happening in the market in which your investments operate within is really important. So to summarize, Do your research. You really do need to be confident in your decisions. You could also say you need to be brave in your decisions. Follow the news, watch for changes as they come about, and really be mindful of the possibility of disruption. With all this new knowledge, how can we use it? Well, for an extremely low risk option, there is on the ASX website the ASX share market game. What this game is all about is learning how to direct share invest, but by not using real money. You are using, of course, fake money. I would highly encourage you to give this a try. The game lasts for 15 weeks, so just under 4 months, and it gives you a chance to buy and sell any of the top 200 ASX listed companies. Now, at the time of this recording, the ASX may change the nature of the share market game, what offerings they have in terms of whether or not you can buy and sell the top 200 ASX companies and how long it lasts for, but at this point in time, those are the current arrangements with the existing game. The time frame involved in this game, of course, being just under 4 months, is long enough to give you real-world experience in investing, doing the research and being active or passive if you want, and familiarising yourself with everything we've covered in this topic so far by basically putting it all into action. To sign up for this, please go and visit the website address, which is https://www.asx.com.au/investors/investment-tools-and-resources/sharemarket-game, or just simply Google it. But please sign up and have fun, because that's what this is meant to be about before the real game begins. Thank you all so much for your time today. I really hope you enjoyed this video, and as always, if there is future content or questions that you have that you would like us to create content about, please feel free to reach out. And happy investing, everyone!